Hello, everybody. Welcome. This is revenues versus unearned revenues, and we're going to be looking at this as a very basic level. This is kind of for my first exam that I generally give, which is no adjusting entries. Okay. So let's go ahead and take a look at this over here. The information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College, the South Orange County Community College District, or California State University of Fullerton. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2022 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Okay, so I had another question from a student in terms of, and again, this is not for anything to deal with adjusting entries, but when do we record revenues and unearned revenues, and why aren't unearned revenues revenues? Okay, so let's kind of go through and take a look. So this kind of goes back over here. We want to use T accounts whenever we're recording transactions, at least initially, because this will tell us what we're doing, right? So DCERAELOE, we're recording revenues with credits, we're recording expenses with debits, assets are increased with debits, decreased with credits. When we have revenue, we're generally going to be recording revenue with credits. There's going to be some exceptions to that, of course, if somebody made an error and we have to adjust it, but that's generally the case. For unearned revenues, right, which are liabilities, right? So this is basically liabilities are going to be increased with credits, and then they're going to be decreased with debits. Now, in terms of when we are recording a transaction as revenue or unearned revenue, this depends upon whether or not we have performed the service. If we have performed the service, we are going to go ahead and record revenue. Now, for revenue recognition, believe it or not, there's actually a 5-step process that you're going to learn about in intermediate accounting, but that's intermediate accounting. We generally define it for like the lower, for your class right now is going to be, have I done the work? You know, is it realizable, is it realized or realizable? But it's really about, have I performed the services? So that's one of the main components. But for this point, because if we went to that 5-point definition, that's just not going to be as fun. So for our purposes here, if we perform the services, we're going to record the revenue. But if we have received cash, and this is really important, if we get cash, but we have not yet performed the services, we have an obligation, and that obligation is to perform future services. So therefore, we are going to be recording unearned revenue. Unearned revenue is not revenue. Why? Because we have not performed the service. Remember, if we perform it, right, we're generally going to be entitled to go through and to record that revenue. There's some other nuances, but in general, that's what we're going to be going through and doing. So the biggest difference is between the two of revenue and unearned revenue is if we've done our job. So over here, her DEP receives $90,000 cash for future services that it will be performing. So they get this money on September 1st, but they're going to perform the services from 1/1/24 to 3/31/24. Prepare the required entry on September 1st. Now, again, this is a very early on accounting example. This is not doing anything with adjusting entries. But over here on September 1st, what's happening? Well, on September 1st, right over here, I am getting cash, right? So I know that I'm going to be receiving cash right over here in the amount of $90,000. Now, for every debit, I need a credit. Can I recognize revenue? And the answer is going to be no. Why not? It's because I have not yet performed the services. The services are going to be performed in the future. So until I've actually gone through and performed them, I cannot recognize the revenue. So what I'm going to do is I'm going to record a liability. This is going to be unearned revenue. Okay, so over here, and if I come take a look at this, this is going to be $90,000. I'm going to show you something really quickly, and I'll be right back. So this over here is the balance sheet of Tesla. And it's not going to be called unearned revenue per se, but this is as of June 30th, 2022. If we come down here and take a look at this, So if we look at here, deferred revenue, right? That's another way of saying unearned revenue. What does this mean? Well, if a client has paid money for a future upgrade that Tesla has not yet received, have not yet issued, then Tesla, if they have the obligation to perform those, to provide that future upgrade, they cannot recognize the revenue until the work is performed. So you will see that over here as, basically is 1.8 billion, right? So these are in millions of dollars, right? So this would be 1.8 billion. Over here, a customer deposit. So I got money for a Cybertruck, right? In a way that's going to be kind of like unearned revenue. But again, because I haven't delivered the Cybertruck yet or some other vehicle, because of that, it's a deposit. I cannot recognize that as revenue I've gotten because I haven't delivered the vehicles yet. So if I receive money from a customer and I haven't done the work or I haven't delivered the goods, or it's for a deposit for something that has not been yet created or mass produced, I have to record the credit as a liability. I know I'm debiting cash because I've got the cash from the customer, but I can't record it as revenue, right? I can't come down over here and say, oh, this is automotive sales, automotive regulatory credits, leasing. I can't go through and do that. Rather, what I have to go through and do is I have to come over here and show this as a liability. So that's one of the really big important distinctions as we're going through and looking at these different parts. So this is example one. Okay, so over here, when I go through and I do my journal entry, I'm going to be debiting cash. I'm going to be crediting unearned revenue because again, I will be performing the services in the future. 90,000 debit. How do I increase my liabilities? I increase my liabilities with a credit. Okay, so over here, this is going to be 9/1/23. I'm debiting cash for 90,000. And then over here, I'm going to be crediting unearned revenue for 90,000. Does it make sense that I'm crediting unearned revenue? Yes, it's a liability, right? I have to perform the services. Okay, so over here, this would be something like cash received for services to be performed from 1/1/24 to 3/31/24. So that's how we do this first example. Remember, we haven't performed the services. It's a liability because I still need to do it. Okay, now here I received $90,000 cash for services that I performed in the past, right? So over here from July 1st through August 31st. So prepare the entry. So because I've actually performed the services, what I'm going to go ahead and do is I'm going to go ahead and debit cash. And I'm going to be crediting over here services revenue, right? So my cash received is going to be 90,000 bucks. And I record the revenue because I've earned it, right? I've performed the services, so I can record it as revenue, meaning that's what I generated or that's what I performed during the period. When we look at Tesla, and if I've made a sale and there's no future, obligations, right here, I can go through and record those automotive sales. So that's what we want to kind of be, thinking about over here. If I've performed it, if I've delivered the Tesla to the driver, I can go through and record that revenue. So over here, coming over to my journal entry, I'm going to have cash. I'm going to have services revenue, debiting this over here for 90,000, crediting services revenue for 90,000. The T accounts basically become the journal entry 9/1/23. I'm debiting cash for 90,000. And I'm going to be crediting services revenue for 90,000. Okay, so to record services performed from 7/1/23 through 8/31/23. So that's how we go through and kind of tell the distinction in terms of between the two. But remember, if we've done it, if we perform the services, I can record the revenue. If I haven't done it, it's going to be a liability or it's going to be unearned revenue. And this is a great question because I always get this question from students is like, when do I record a revenue versus unearned revenue? So I want to thank you for joining me here today. Please don't forget to like and subscribe. If you'd like to see any of the other kind of questions be offered up here, feel free to send me a message to 1812cpa@gmail.com. Have a great rest of your day. Have a good one.